Well, this is Dr. Wang recording. In the previous exercise, we did the valuation of stocks, and in this practice, we will learn margin trading of a stock. So margin trading basically means you are borrowing some of the money to buy the stock plus your own money to buy the shares. So borrowing allows you to buy more shares. So if the stock return is positive, then you can make more returns. You can make more money. On the downside, if the stock price drops, then because you borrow the money and you have a larger position, then that's going to cause larger damage to your position. Okay, so the margin transaction or margin trading is actually my topic of my PhD dissertation. So I will not let it go. So I have to lecture on it because of my own interest. So if you look at this PowerPoint slide, it's actually from textbook chapter 3. That's a topic there. So when investors buy stock, they can pay for the stock with cash or borrow part of the cost. That's leveraging the transaction. So leveraging basically means borrowing. And we call this a buying on margin. So the investor pays for the stock with some of the cash and borrows the rest through the broker. So each of us, if we want to buy a stock, we have to go through a broker. Even though you buy it electronically, your broker is an electronic platform like a Robinhood, like E-Trade or TD Ameritrade. And the stocks you purchased would be as the collateral for your position. So if you are losing money, then the broker will take your stocks. And how much money can you borrow? For stock trading, it is 50% right now, and in the history, it can be lower as 20%. So the margin requirement basically is how much money of your own must be paid before you can borrow. So 40% trading on margin, that means you need to put a 40% of the, you need to put your cash as 40% of the position, or 40% of your position needs to be your own equity, and the rest is 60% can be borrowed. If the borrowing requirement, if the margin requirement is 100%, that means no borrowing is allowed. So 100% of the money has to come from your own pocket. All right, so after the initial purchase, of course, the stock price will change accordingly to the market. So when the stock price increases, then your equity as a proportion of the total market value will increase, and your investor margin will exceed the initial margin requirement. And if the stock price drops, of course, your investor's margin will drop accordingly, but the broker will not let it drop to zero. So actually, if it drops down to a certain level, the broker will execute margin call. So margin call basically is the minimum maintenance margin must be maintained. So if your own margin drops below 25%, then the position has to be liquidated automatically. So that means the broker who holds your stock will sell the stock immediately to cover the money they loaned to you. All right, so I think if we put it into the practice, you will understand a little bit better. So right now, assuming about 200 shares of a $50 stock and borrow the maximum amount given the initial margin requirement of 50%. If the stock price increased to 60%, what will be your equity position? So right here, you can see that the total market value, stock value is $60 times 200 shares, so that's $12,000. And then you borrowed $5,000 from the broker, and your equity amount is $7,000. So your equity position is $7,000 divided by $12,000, and that's a 58%. That is higher than the initial margin requirement. So you start with 50%. Because the stock price increase, you have 58% equity position. All right, so let's put this in Excel practice. All right, so I want you to get a current price, and that is $50, and then the shares purchased, and that's 200 shares. Okay, and then the later price can be at a different level. So for now, the later price, let's say it is $60. Make it all lowercase, sorry. Okay, and then I want you to get the your equity position percentage. So the margin requirement here is 50%. All right, so your total current value, current stock value, you can do a calculation. That's $50 times 200 shares purchased, and then fund borrowed and own equity at the start. Okay, so the fund borrowed means you need to use $1,000 times 1 minus the 50%. Okay, it's very important if you realize it is 1 minus 50%, not just 50% by itself. Because if margin requirement drops to 40%, then you need to borrow. You can borrow more money. You are allowed to borrow more money. If margin requirement increases to 100%, then you are not allowed to borrow any money. Okay, so for your own equity at a later stage, right? It really depends on the price level at a later time. So you will need to multiply the later price by the share you purchased, okay? And then you need to return the money, $5,000, to the broker, because that does not belong to you, all right? And then you divide the whole thing by your new position, which is shares purchased and the later price. Okay, so this has to be in the set of parentheses, sorry. Okay, so that's a 58.33%. Okay, so if I change the price to $70, you can see that your own equity increases. If I change to a higher level, your own equity as a percentage also increased. All right, and then in addition to the textbook, I want you to calculate the stock return. Okay, the stock return is a 60 divided by 50 minus 1. We have done this millions of times, so that's a 20%. And I also want you to calculate your own return. As the investor, you borrow the money, what is your own return? Okay, so you need to first get to know what is your initial investment. All right, your initial investment is the current stock value times the 50%. Not 1 minus 50, but 50. So that's your own cash you put into this investing business. All right, and then your own return is whatever this base investment is. It's generated from that. So you will need to use the later price times this share purchased minus the money you borrowed that does not belong to you, all right? And the rest will belong to you. So this basically will give you $12,000 from the later higher price minus the $5,000 you borrowed, and then divided by your initial investment, okay? And of course, you need to subtract it by 1 to get the return. So that is 40%. All right, so what you see here is if you're trading stock, 50% of your money comes from your own, and you borrow the other 50% through a broker, then your return will be doubled. All right, so if I put this as a 25%, then your return will be quadrupled from 20% to 80%. And if I put it as 10%, your return will be 10 times higher. If I put it as a 5%, it would be 20 times higher. I want you to look at the stock return and your own return as well as the margin requirement. Does the stock trading have a margin requirement of 5%? Of course not. The Federal Reserve, the central bank of this country, will not allow it. But in the futures trading market, which is different animal of securities, the futures is for the commodities, the cryptocurrencies, foreign exchanges, and that's for the futures price, the future delivery of the commodities, all right? And margin requirement for futures can be 5%. For stocks, the minimum in history is 20, but for futures is always 5%. So that means your own return could be 10 times higher than what you see here. All right, so let me recoup. So if you can calculate the stock return, so what you can do is just use the stock return divided by the margin requirement. Nice and easy, okay? Nice and easy. So if the margin requirement is 80, then you will see you get the same result. Stock return 20%, your own return is 25%. If the margin requirement is 50, then that's gonna be 40. All right, so that happens when the stock price increases. Let me change to a lighter color. All right, so what about if the stock price drops? The current price is $50, and what about if it drops to 40? All right, so when the stock price drops to 40, of course, the current stock value is still $10,000. That's depending on the current price and the number of shares you purchased. All right, but the thing is, the stock price decreases, and you still have to give back the fund you borrowed at the beginning. Then your initial investment still $5,000. So in that case, your own return is amplified. Okay, in the same way, but in the same magnitude, but in the opposite direction. So when stock price drops, your own return is amplified. So if the market requirement is 100%, so it's just the stock return because you did not borrow money to negative 20, negative 20. So if the margin requirement is 5% as the futures trading, then your return is actually 20 times worse than the stock drops. Okay. So I want you to look at your own equity for this one, because we will be facing a situation here. It's called maintenance margin. Okay, maintenance margin. And the Federal Reserve makes maintenance margin as 25%. So 25% basically is this number dropped to 25%. Then, and that's the time that your position will be automatically liquidated. They don't wait until your own position drops to zero. All right, they don't wait until your own position drops to zero. So for example, if it dropped to $10, then your own position can be negative 150. So what makes your own position get to zero? When it's $25. Okay, so what you see here is the stock price drops to $25. So that's cut in half, and the stock return is negative 50%. Because of your margin requirement is 50%, so your own return is enlarged to negative 100%. So that means all your equity is wiped out. 100% of your equity is wiped out down to zero. But the broker will not allow that to happen. That's too dangerous for them. They will let you go down as low as 25%, and then they will enforce you to sell the stock off. Okay, so what will be that margin call stock price? That's what we're solving. So you will need to use the data function, and you will do what if analysis, and you will check goal seek. All right, so you want to set this later price. So what would that be in order to make your own equity as percentage to 25%. All right, so I'm going to put to a value of a 0.25, and I want to set this number, your own equity, okay, to be 0.25 by changing the later price. All right, so this is how we do it. And then upon clicking on OK, all right, Excel will automatically perform the calculation for me. All right, so as you can see, Excel, the best it can do is 24.98%, which is pretty close to 25%. And that occurs when your price is $33.32. Make it a dollar format. All right, so what about if I change it to 33.33? It's like actually getting closer. Okay, so let me just do the solver again to see if it can give me a better result. Okay, make this guy equals to 0.25, and then by changing this later price, hit OK. All right, so that's the best I can do here. If I decrease a decimal, that's going to show as 25%. Okay, so how could you do that in Excel? In a regular calculation, so what you do here is you're going to solve it through the mathematical formula. So you will need to get the margin call price based on the equity position divided by the total position. Okay, that's all determined by the price. Okay, and that's basically what we did, and you solve it based on the solver, but this one can be done in very simple line of a mathematical formula, which is 1 minus the amount you borrow times the current price. Okay, so let me just show you how to get this 33.33. all right, so basically you have a later price, and 1 minus, it equals to 1 minus the amount of shares times the later price. Okay, I use the amount of borrowed divided by that. Okay, and I want to make this as $25. Okay, so this one I want to make it $25. All right. So basically, you will need to solve it backward. So it's a 25%. All right. So P, the current price, the later price, based on this line. So let me just copy it. Oops. Okay, it equals to 1 minus 25%. Okay, that's a 75% of the money will be the money you borrowed, because 25% is your own, 75% will be the money you borrowed, and the 5,000 will be the money you borrowed. So that would indicate to a $6,667. Okay, so for your total position, and your total position is that, but that's made up 200 shares. It's based on 200 shares, so divided by 200, then you will get this number. Okay, so to wrap it up, I'm going to do this. So I will use the amount of borrows divided by 1 minus the margin call price. All right, and then divided by the shares purchased, 33.33. So that's nice and easy. So you don't have to do the go seek function. You just need to trust the math formula, which is the money you borrow over 1 minus the margin call requirement of 25%, then divided by the number of shares. I'm gonna recoup the setting. So based on the textbook, I will recover it as $60. So everything get back to the original setting. 58.3% is equity, your own equity as a percentage. And this is 33.33. I should name it as the margin call price, at which price you face a margin call. Okay. All right, now I want you to create another spreadsheet, and this time I will just simulate a lot of different later price here, from $10 to $11, okay, and all the way to $90. Okay, so these are the possible range for the stock price to vary. Okay, from 10 to 90. All right, and then I want you to calculate the stock return. All right, so stock return is whatever the later price is divided by the earlier price of $50 minus 1, and that should be in percentage, just like this column should be in dollar figures. All right, and for your own return, you just need to use the stock return divided by the margin requirement of a 50. Okay, nice and easy. So this is very simple to do. Okay, or you can use another way to get your own return, which is you will need to figure out how much money you borrow and get your later stock value. Okay, later stock value is this amount. This is a dollar price times 200. Okay, and then the fund borrowed from a broker. It is, well, let me just go ahead and do the calculation here. You buy 200 shares for $50 per share, then this amount will times 1 minus 50%. So that means the rest 50% will be borrowed. Okay, and then you will need to calculate your own equity. Okay, your own equity is the stock value minus the money you borrow. Okay, so of course right now you are below, you are under the water, but if the stock price keep increasing to $25 to $26, then you will not be down zero, but you still have a pretty bad losing situation, because you started with $5,000, but you just have 200, 400, and 600 left if the stock price changed to 26, 27, and 28. Okay, and then that's the later equity. Okay, based on the later price, right? And then you need to get your own return. That's gonna be the same result, and this is gonna be your equity later minus whatever you started with. You bought 200 shares at $50 per share, and then 50% is from your own pocket. Okay, and then the whole thing minus 1. Oops. The whole thing minus 1. Sorry about the hiccup. Okay, so that's 160% losses on your own. And then I just double click on it, and you will see this is your return, which is consistent with this column calculation. It is just the stock return divided by the margin requirement. Okay, and then you can calculate your own equity. Later as a percentage equity. All right, so you're gonna do this. You're gonna use your own equity divided by the later stock value. So this is gonna be negative 150%. All right, And 0% is when you have no equity in that. And 25% is somewhere here between 33 and 34 for the stock. So you will reach an own margin at 25%. Okay, so the price would be exactly 33.33. Okay, so I want you to perform this calculation based on different stock prices, and I want you to mark these two rows, okay, because that's when the margin call will start, 24 and 26%, given your margin call is 25. And that will happen if the stock price drops from $50, the current price, to $33 or $34. So this is your start point. If it drops to 33 or 34, you're gonna face a margin call. And they will not let you to drop down 22, 19, 4%, 0%. The broker will not allow that kind of drop. They will force you to sell the stock, and you will retain 24% of it, and the $5,000 will go back to the broker.